Hello everyone, welcome to session 8. In the previous session, I've discussed exercises on preparation of books of accounts on dissolution of firm due to insolvency of a partner, wherein the capitals were maintained under fluctuation method. In this session or in this exercise, I gotta show you when capitals are fixed, then what changes it's gonna have while preparing the books of accounts. Let's start our discussion with an exercise. So I have brought an exercise, so I'll read it out for you, and I expect you to please make a note of it so that you can understand in a better manner. X, Y and Z were partners in a firm, sharing profits and losses equally. They decided to dissolve the firm, on which date their balance sheet was as follows. The liabilities, assets have been provided. So on the liability side, you can find the capital accounts of all the partners X, Y and Z, current accounts of X and Y, reserves is given, bills payable we have, as well as creditors on the liability side. On the asset side, we have debtors less provision for doubtful debts 500. So net debtors is 7,500. Building worth rupees 17,000. Stock 9,000. Furniture 5,500. The cash balance is 1,000 rupees. And we have debit balance in current account of Mr. Z. And there is accumulated loss, profit and loss account. So further, they provided additional information. That is, the assets realized as follows. The first asset, building 18,000, stock 5,000, debtors 5,000 and furniture 3,500 rupees. And the second adjustment is the cost of dissolution amounted to rupees 1,500. And in the third adjustment they are telling Z became insolvent and he couldn't bring anything towards his capital deficiency. Prepare the necessary accounts to close the books of the firm applying Garner versus Murray rule. So let's see how to prepare books of accounts. As I told you, compared to previous problem, in the previous problem, capitals were maintained under fluctuating system. Hence, no question of current account arised. In this system, in this problem, we have capitals maintained under fixed. So the question of opening current account arises. So let's start our discussion with, as usual, preparation of realization account. So as I told you, so realization account need to started with transferring all the assets and liabilities at their book value. The same thing has been done. So debtors at its book value 8,000, building at its book value 17,000, stock given in the balance sheet 9,000, furniture worth rupees 5,500. So all these assets have been transferred to realization account at their book value. Now transfer the liabilities. So we have creditors worth 4,500, bills payable 3,500, and we have PDD, provision for doubtful debts, provision is there of rupees 500. After these assets and liabilities have been transferred, the next entry is for realization of assets. That is, at what price the assets have been sold in the market. So for that one, make an entry on the credit side as buy cash. So I have written, so building 18,000, furniture 3,500, stock 5,000 and debtors 5,000. So these assets have realized a cash worth rupees 31,500. In the same manner, we need to make a payment of liabilities. When it comes to the question of ranking, first we need to make payment of dissolution expenses. So hence, the first dissolution expenses to be paid. So two cash account on the debit side. First one is for dissolution expenses 1,500. Then payment to creditors 4,500 and bills payable worth rupees 3,500. So total payment made is rupees 9,500. So after all the entries considered for the realization, we need to make a total. So if you compare the total of debit and credit side, so debit side total is more, it's coming nearly 49,000 rupees. And keep the same total on the credit side, 49,000. If you deduct the credit side balances, we're gonna get a difference of rupees 9,000. So this 9,000 is called as loss on realization. So this loss on realization should be borne by all the partners. It should be distributed to all the partners in their profit sharing ratio. So as these three partners are equally sharing the profits or losses, hence this 9,000 is divided among all the three. So hence 9,000 into 1 by 3, 1 by 3, 1 by 3. So all the partners are getting 3,000, 3,000, 3,000 as their share of realization loss. After this, as I told you, when the capitals are maintained under fixed method, the current account will come into picture. Any adjustment regarding the accumulated profit or a loss should be carried out at current account only. So hence begin with Z's current account because he became an insolvent. We need to prepare his account. So Z's current account we need to prepare. So begin with the two balance brought down because Z's current account is showing a debit balance. So 7,000 rupees. After that, they said that Z couldn't bring anything in cash. So hence we have put 0. Instead of you need not pass an entry here. It doesn't require. After that, on the debit side, you can transfer the realization loss, is a share of rupees 3,000. And we have in the balance sheet accumulated loss. So that accumulated loss should be debited to Z's current account and his share is 1/3. So out of 3,000, his share is rupees 1,000. So that. And on the liability side, we have reserve fund worth rupees 6,000. That is reserves given. So Z's share is 1/3. So out of 6,000, 1/3 is 2,000. After transferring all the related transaction to Z's current account, we need to make a total. If you make a total, on the debit side it's more. It's coming nearly 11,000. So keep the same total on credit side 11,000. We have only one item on the credit side, that is reserves, to be deducted out of 11,000. The difference what we are going to get is 9,000 rupees. So this 9,000 to be transferred to Z's capital. So this is to be transferred to Z's capital account. After this, we need to prepare Z's capital account. So begin with buy balance brought down. Z's capital is showing credit balance, hence we started with the credit side 3,000. And there's only one entry just now we prepared, that is Z's current account. Here I have written on the credit side as by Z's capital account. So this one, the same one to be carried to Z's capital on the debit side as to Z's current account. So 9,000 rupees. Now, if you take a total, debit side is more, this is 9,000. Keep the same total on the credit side 9,000. If you deduct 3,000 rupees, a difference amount is 6,000. Now, this is called as capital deficiency. So, this capital deficiency should be transferred to solvent partner's current account, because the capital, according to the rule of Garner vs. Murray, the capital deficiency of an insolvent partner should be borne by solvent partners in their capital ratio. Then, before dividing the amount among the X and Y, we need to know the capital ratio. As I told you, the capitals are maintained under fixed method. Here, no adjustments are required or no adjustment need to be done with the capital accounts. So now, as usual, take the capital balances of X and Y, that is 20,000 and 10,000. Convert the same 20,000 and 10,000 in ratios. The ratio will come down to 2:1. Hence, here on the top, I am highlighting. So that is 6,000. How we have divided? So we have divided based on this capital ratio only. That is 2/3 and 1/3. So X share is 4,000. Y's share is 2,000. So after doing all this, we need to prepare solvent partner's current account. So as usual, begin with by balance brought down, because these solvent partners current account is showing credit balance. Hence, begin with by balance brought down 2,000 and 1,000, and transfer the realization loss. So solvent partner should share, that is 3,000 and 3,000. So remember, on the debit side we have transferred the realization loss. Remember the rule of Garner vs. Murray. It states that the loss on realization, the solvent partners have to bring in the cash equal to the realization loss. Hence, immediately after that entry, you are not supposed to forget to pass an entry on the opposite side as by cash. 3,000, 3,000. After this, look at the reserves given in the balance sheet. Take that reserves and divide it among the solvent partners in their share as well as profit and loss account. So we have 3,000 rupees. So divided among the solvent partners in their share. After this, on the top, just now what you prepared, just now you prepared insolvent partner capital account. Here you have written by solvent partners capital account. It is on the credit side. So this entry should be brought to solvent partners capital account, and that too on debit side as Z's capital account. So X share is 4,000, Y share is 2,000. How we got this 4,000, 2,000? So it is divided based on their capital ratio. So after transferring all the entries relating to solvent partners, we need to make a total. So now if you look at the total, so debit side is more. So debit side X is getting 8,000 and Y's debit total is 6,000. So we're gonna keep the same total on credit side, that is 8,000 and 6,000. So now if you make a difference we are going to get only in case of X, because in case of Y both the side the total is same, that is 6,000 and 6,000. So hence nothing to transfer to Y's capital account. So the difference in the X capital account, X current account to be transferred to X capital account. So after preparing this one, you need to prepare solvent partners capital account. So capital account as usual begin with the credit balance, that is by balance brought down 20,000 and 10,000, their capital balances, and just now you prepared solvent partners current account. So on the credit side you have written here, that is solvent partners capital account. So the same thing should be made on the debit side, that is to solvent partners current account. So we have 1000 balance in X account and 0 balance in Y's account. So after doing this, take the total. So the credit side is more, that is 20,000 and 10,000. Keep the same total on the debit side, 20,000 and 10,000, and the difference will come down to 19,000 and 10,000. So this difference to be written as to cash or bank account for the final settlement. Now at the end prepare a cash account. So the simplest account is cash account. As I told you, we need to begin only, you need to start this account, that's it. You need to begin with the debit balance, that is 2 balance brought on as we have a cash balance. After that your duty is only to go through the previous accounts prepared. Wherever you are finding the cash on the debit side, transfer all those entries on the credit side of cash account, and wherever you are finding the cash account on the credit side, transfer all those entries on the debit side of cash account. And let me tell you, at the end your cash account must tally. So in this case we have transferred for the assets realized, and we have also transferred on the credit side, that is 9,500 rupees for bearing the realization expenses and for payment of liabilities. After this, the cash brought in by the solvent partners equal to the realization loss is entered on the debit side, that is 6,000, and at the end we made the final settlement to solvent partners, that is 29,000. So if you do this much, your cash account must tally, and it will tally. So with this we're going to conclude for the day. Thank you.